What's going on, everybody? It is Geoff Curtis, and we have ourselves a hot take video. Oh, a hot take video. There it is. All right, before we can get into the hot take, I need to make sure you know that I am Geoff Curtis. I am a licensed real estate broker in the state of Montana, and I am also a licensed lender in the state of Montana, which means I have an NMLS number that is there with my website. All right, so now that those disclosures are done, let's get back into the hot take portion. These hot take videos are where I talk about something that is, kind of hot in the market right now. And that is, on the lending side, temporary interest rate buydowns. Okay, temporary interest rate buydowns are wordy. There's a lot to them. I like it where I can solve a math problem, and these aren't easy math problems to solve because there's so many factors that go into them. So, really quickly, a temporary interest rate buydown is typically where the seller gives you a seller credit for amount of money that will pay a portion of your interest for some amount of time. So it could be 1% of your interest for 1 year, it could be 2% of your interest for a year, and then 1% of your interest for the second year, and then you're at your full rate, or you're responsible for your full rate, or it could be 3% of your interest for the first year, and 2% the second, and 1% the third. So if your rate, let's say your rate was 7%, you're locked at a 7% interest rate for 30 years. The first year you're paying 4%, they're paying 3%. The next year you're paying 5%, they're paying 2%. The next year you're paying 6%, they're paying 1%, and then you're at the 7% rate for the remaining 27 years left on your loan. One of the advantages of the seller paid buy downs is that if you refinance, the unused amount is a principal reduction. Okay. Folks, the education is lacking, I think, from a lot of lenders on what your options are for seller credits. So let me just state this. Generally speaking, if I knew you were going to be in a house for 5 years and you were looking at a large seller credit, so let's look at a 3% to a 2% to a 1% interest rate buy down, temporary buy down. I'm starting to see those as $20,000 seller credits. So you have a $700,000 house and you're getting a $20,000 seller credit. You have 3 options. With that seller credit, you could negotiate a lower sales price. So instead of $700,000, you're at $680,000 sales price, and you take the market rate, interest rate, and you move forward. Okay. Option 2 would be that you pay $700,000 for the house, and you do a $20,000 permanent interest rate buy down. So you buy down your interest rate permanently, and it's permanently at that rate until you sell, refinance, or at the end of your 30 years if it's a 30-year mortgage. Or you can do the temporary rate buy down, and there's all sorts of different options. Generally speaking, if I knew you're going to be there for 5 years, I would rather you take a principal interest rate reduction. My second choice would be a permanent interest rate buy down, and my third choice would be the temporary interest rate buy downs. Generally speaking, if you're totally only concerned about what your payment's going to be for this year or next year, then I understand that. But a few of the things that concern me is, number one, lenders aren't talking about the options. Each one of those options has different outcomes based on what happens. So if you can't refinance within the first couple of years, they become less and less valuable, or which one's best for you over the long term can change and does change. So here's what I want to say. Let's say you have that $20,000 option. Okay. If you take the temporary interest rate buy down, please realize that you are not guaranteed that rates are going to go down. A lot of people and agents, lenders are saying things that I don't think they should be saying about, well, when rates go down, you'll just refinance. We don't know that rates are going to go down. We really, truly don't. And I'm not so sure that they're going to go down like everybody thinks they are. We may not see 4% rates anymore. So with that, when interest rates, or if interest rates go down, we also sometimes see housing prices lose some value. So if you don't take the principal reduction, you may need that house to appraise at a higher value later on to refinance. And if the house has gone down in value, you may not be able to refinance due to what your appraisal comes in at, or where your income levels are, or if you've had to take on more debt, or if you've changed jobs. There are a lot of things that can stop you from being able to refinance that are somewhat out of your control. So you're not guaranteed that interest rates are going to go down, and you're not guaranteed that you're going to be eligible to refinance. So that is a concern that people need to think about. Okay. Also, on a permanent interest rate buy down, if you can buy your rate down 1.5%, or 2%, you may not have to refinance as many times. And each time you refinance, it costs you money. You have to pay for new title policies. You have to pay for underwriting fees. I mean, you don't have to pay for them, but they're factored in the loan. The lender's going to make money somehow. The appraisals, I mean, it is easily $5,000. I've seen them as high as $8,000 for, by the time you do the appraisals and the new title fees, and you pay, an underwriting fee of $1,000, you're at $5,000 before you know it. So if you have to do that a couple of times, you're at $5,000, $10,000, $15,000, $16,000 on 2 of them. That eats up a ton of your savings. So if you can make it to where you don't have to refinance via a permanent interest rate buy down, that absolutely could be the best bet for you. Now, it also could be that if rates do drop quickly and you don't have to pay the interest for 8 months or a year, and then you can use the rest of that seller credit for a principal reduction and refinance, it might also be the right option. But I think too many people are not being educated on their options and are staying too focused on what their payment's going to be the first year of the loan and not thinking long term. So I encourage you to work with your lenders or find a lender that will talk about all of your options. Make sure you know what your options are and what is going to have to happen for that to be the right option for you. So with that, I am Geoff Curtis. If you have any questions, please reach out to me. But that is my hot take for today.